So anyway, we'll while Blake's working on, and maybe it's me. I don't know. Where
Is
is
it
it?
you? Can you hear me okay?
Yeah, I can hear you. I'm just getting like feedback on mine.
Oh,
Let's try my.
hmm. So while you're figuring out if it's your end and we're wait to see any comments to see if it's on my end, let's get rolling, as Eric says. Good morning, Ray. Hello, Shirley. I'm okay. I'm fine. I'm resilient. I what's the line? Remember, it wasn't a great movie. Do you remember in GoldenEye, the geek that was supposed to be programming the satellites and everything? He goes, "I'm invincible." Remember then right before he gets blasted and frozen instantly. Anyway, so I'm invincible. That's what it comes down to. So thank you though, but I'll be 100% my Monday for sure.
Yeah.
So that's the
Well,
way I
I'm
work.
I'm I'm back. I just realized when you have a gazillion tabs open, there may be one that is lingering and lurking. I had an extra Theo Live. So I was like, I had a pause. I was ready. I'm not going to see her this time, but yeah, it was. I had another tab open. Sorry, folks. But
So
let's dig into the meat of things today. We are fed up. We got our 50 cent,
that's
fifty
right, bitty,
percent rather. What do you think, Blake? I mean,
bitty,
was
bitty
this great
basis
timing
points.
by the Fed? Just come out the 50, the bazooka, as Paulson back in the financial crisis talked about.
So I don't know if you could see on my face when we were recording live in there. I think I'm a stoic in many ways when it comes to market conditions. Good or bad, it doesn't really. I don't get overly excited, overly upset about things, but I was honestly shocked, and because this is bad. I don't see anywhere around that this is not a sign that we are in trouble, deep trouble. And so when it came out and I was watching it, and I skipped right past my stop on a position on the futures. Futures skipped past my stops. That's not good, by the way. That's
Mhm.
horrendous. And so, and I just think that that was I mean, what are they saying? That it's preemptive, that we're front loading, that we're doing something. But I think this is bad news. This is horrendous news. This is
Yeah.
telling us that the economy is destroyed, and they're going to try to fix it a little bit earlier than inflation. In other words, we don't care about inflation nearly as much as we care about keeping the stock market high. That's my view on it, and and I know that that's not necessarily everybody's view, but to me, it was bad. It was horrendous. I just don't see any way around saying that this is
Yeah.
this is bad news.
We're going to kind of dig into that reasoning. And look, I mean, if you want to see, the result of Powell, right, the 50 basis point cut, all you got to do is look at skew, right? I mean, is the perception of risk lower post Fed? They show the bazooka, they cut the 50. We'll talk about the reasoning about that, but skew popped to 171. It's an all time high. Basically, what the market is saying, as this goes up, the hedging activity is increasing. They're saying that the downside risks have never been greater, right? So Powell here is trying to step in and say, hey, we're just preemptively, we're just massaging here. We're just trying to keep the market going. We're trying to keep them primed. And yet the market's coming back and saying, you know what? Tail risk has never been greater.
Well, put that in perspective. If tail risk has never been greater, we're talking about greater than when we had the housing bubble, greater than when we had the dot-com bubble, greater than the 1980s with double digit, or late 70s, early 80s, double digit inflation and stagflation. We're saying that we have never been higher.
Yeah. Eric
That's
saying,
not good.
Eric F says, the commentators that I heard said inflation is already handled. Well, the
Yeah,
reality
that's
is,
what
I
they
mean,
said. That's what they
I,
said.
I get it,
Correct.
right? I'm like, Powell did pretty much declare with the 50 basis point cut, mission accomplished. We're going to look at some super core numbers, which he says is important. Apparently not. But the reality is the Fed had changed their inflation mandate without explicitly changing, right? They didn't give a standard. All they said is, we're willing to allow inflation on hot. And the reality is inflation is still running hot. Whether or not you get 1 month where you fall in line on a month over month basis into their kind of target 2% range, which, by the way, is not helpful at all. Okay. That's still rampant inflation. But at least
Well,
that's
and
what their target is. They're still running above that.
but that's not even really 2%. They said it's 2%, 2%. We're gonna go 3. Don't tell anyone we're going 3.
Right. Right. I mean, year
And
over year, we're still three. For a
Yeah.
month, we hit that 0.2%. But so let's talk about Fed in the 50 here, because there's kind of a four-pronged, and I talked about this early in the week about when we had our meeting on Wednesday, the Theo Live on the Fed, and I read a little something where someone basically called it the same thing. We've hit the economy a lot, right? I mean, the economy right now is faltering a little bit, particularly employment, and when employment falters, that's when you're in a recession. I mean, you look at the yield curve's uninverting except for in the very short term. Again, that's indicative of entering recession. I mean, anything out there, Blake, right now that for you from an economy perspective that says, hey, we're great shakes. We're really doing well.
I think the only thing that I would say is a sign of that we might be doing well, which is false, is if you're trying to track industrials and financials, because they're generally the early market turn. And so when we see industrials start to recover and financials start to move, you could say, oh, okay, so we're in recovery phase. But financials are only offsetting less of catastrophic worst case scenario because they've never been carrying so much bad debt or unrealized losses. I didn't say bad debt, let's call it unrealized losses. They've never been at this level of unrealized losses. So we're going to lower the cost of those unrealized losses. And that's good. It
Yeah.
is less bad, but that's
Right.
not good. So we're trying to say that this is better. We're good. Don't worry about it. But
Yeah. And we'll actually
again,
see an
it's not
image on
great.
that. But let's talk politics here for a minute. I mean, if you look at, I mean, Trump says he's not going to reappoint Fed Chair Powell. If Powell wants to remain Fed chairman, Harris is his only hope, right? So this isn't a political commentary other than saying Powell, if he wants to be Fed chairman, he's got to please somebody. And one of the two candidates that will be president has already
So far.
said you're a no go. We're not
Yeah.
going to we're not going to renew your license.
There's no guarantee
Right.
that Kamala will keep him, but there's
No.
guarantees that he won't be there if he goes the other way.
Right. Right. It's like, it's Princess Leia in the ship giving the message to R2D2. In this case, Powell's sending it to Harris saying, you're our only hope, Obi-Wan, right? You're our only hope, Harris. Or you're my only hope. So if he wants to remain Fed chairman, there's only one pathway to victory in terms of him staying in power, and that's if there is a President Harris. And so again, I'm like, he's accommodating now. Maybe is it political? Look, they're always political. I do not believe that there's any degree of Fed independence. Never has, never will.
Well, and maybe we do this a little bit later, but as we're looking at this and we're talking about both Powell and Harris came out that day and said, see, 50 basis point cut means less inflation.
Yeah. So someone's saying president doesn't pick the Fed chairman. Well, they actually do, and they got to be appointed, right? So
it's appointed. They select them, then they get appointed. It's like judges.
now the next one here is something broke. So we think about banks, right? I'm like, one of the issues we've seen, and the Fed had to step in. You look at this little downturn right here, for example. We saw deposit outflows, we saw bank failures. And again, I mean, right now we're seeing that the term that was used is fragility, right? In this article I read, but the reality is banks are not doing well. Deposits are flowing out. This has historically just been a straight line up. And in the last couple of years, people have been moving money to the money markets and other means. They're avoiding the banking sector as for their deposits to a degree. And we're seeing that deposits have not continued to rise. They falter a little bit, which ultimately limits to some degree their ability to lend. But again, we're still talking about massive deposits in banks still, but the pace of increase is diminishing.
Yeah, well, and certainly something has changed in the banking sector where it's not when people say it's no longer a reserve banking system, yes and no. It is a reserve banking system in that it is still dependent on the reserve, the Federal Reserve, and how they lend money in bonds or treasuries, but they're not dependent on the deposits for their lending. And it's shifted away from commercial and consumer deposits or the retail deposits into we leverage up those bonds. Like we talked about at the live event, you just leverage up the bond, leverage up the bond, leverage up the bond. But to me, the deposits of the commercials are a lot more than just saying that the banks can or cannot lend. it means they can't profit as much, one, and two, it means that businesses aren't growing. And if they're not growing, the employment data is going to get worse.
Yeah. And that's the thing is, I mean, right now, I mean, corporations are sitting on a mountain of debt. The public sector, I mean, the governmental sector is sitting on a mountain of debt, and the private sector, just people, households, are sitting on a mountain of debt. And I'm going to throw this last one out here because, again, somebody brought up on Wednesday, is that the Fed itself. So I looked at Soma Holdings earlier in the week. That's the holdings of the Federal Reserve. They're holding trillions of dollars. In fact, I may have it up still. In fact, as a a tab in here. So let me just right here, Soma Holdings. So $6.5 trillion here, but again, $3.7 trillion in notes and bonds. So that's, we're talking like not just short-term T-bills, which what they used to own. Agency-backed securities, $2.29 trillion of agency-backed securities. They've got some tips in here to 344 billion. The problem is they raise rates at the fastest pace in history. They have massive unrealized losses. And right now, what's happening is they're losing $5 to $10 billion a month. Now, normally they're paying what, $5 to $10 billion a month to the Treasury in terms of profits. This is the entirely different scenario. They're losing $5 to $10 billion a month. At some point at this pace, they're going to have to be recapitalized. Otherwise, again, they're going to have to expand and create inflation to try to diminish this by lowering interest rates. And so we cannot underestimate the fact that the Fed is talking their book right now. And by cutting rates, they're trying to make their own book look better.
Well, and it's the same. I think it's just the Fed or the banks, not just when I say the banks, I'm saying the large regional banks and the big banks. This is the same thing. We're just trying to make us look better when we're in these massive losses.
And then the last thing is just talking about inflation, right? So is inflation tamed or inflation is tamed, right? Powell, I mean, has talked about super core inflation being the most important, right? In fact, let me give you the quote right here. The most important category for understanding the future evolution of core inflation is super core, Blake.
Super core is better, new and improved tide.
Where's our 2%, Blake? I'm looking right here, right? These are year-over-year numbers, right? Where do I see 2% in here? So this is the most important, gives us the most insight in future inflation. And the year-over-year numbers, we're talking 5% in Supercore when you take out energy, services, shelter, et cetera.
Well, and so, yeah, so think about what he's saying here. Before is core, meaning take out food and energy, right? Simple. Take out food and energy because you're going to spend that anyway. Now they're saying, well, take out food, energy, shelter, rent equivalent, any services you might do. Take out anything that you spend money on, and we'll tell you that there's not as much inflation.
Right. We'll just keep stripping it away, right? So if it's Game Boys, we're going to take out Game Boys. Do people even play games on Game Boys anymore? I don't know.
I don't think so.
The point is, whatever it is, we're going to strip it out. But the point is, this specifically,
hipsters to be ironic play at Game Boys now.
That's right.
Anyway,
that's right. But the idea is that inflation is tamed is not real. So all of this coming down, how is this working for the bond market? So if we're thinking about Fed losses and we're seeing what's happening post Fed announcement, the 10-year yield made a nice pop the last couple of days. We're back up to 3.7%, the 30 years at 4%, the 5 years at 3.5%. So yes, they did kind of normalize the curve once you get away from 3-month T-bills, but the reality is long-term rates are rising, which if they're holding $3 trillion in notes and bonds, this is not exactly maybe what they're hoping for, unless we're really start pointing to the fact the economy is really faltering. They're preemptively cutting 50 before they're going to call the recession. And inevitably these rates are going to come down along with it. And they're going to have to cut even more.
Well, and they're going to still do the same thing like we talked about before, is that we won't call a recession until 6 to 12 months after we were really in a recession. We'll always delay that and tell you in hindsight, we were, but now we're coming out of it. They want to be able to say, yeah, we were in a recession, but we're coming out of it now. They want to be able to not tell you how bad it was or is until it's starting to improve. Kind of like what they're doing with their balance sheet.
Well, because I mean, look, let's go back to 2008. The reasoning by media and politicians and policymakers was what? that if you say it out loud, you're going to cause it. If we didn't say that the banks' balance sheets were imploding because of credit losses, if we didn't have to mark that debt to market, we would have never had a crisis. That we can, if we just believe that we're okay, we will be okay. We don't have to recognize losses. Someone named Don Kaufman in our Theo live chat, don't know if it's real or not, says, Game Boys, what is this 1999? You have to remember, inflation is about hedonic adjustments. So if the Game Boy is improving, is it inflation or is it improvement? So thus the Game Boy reference. But anyway, but TNX, we're seeing yield curve steepening. And on the back of this, obviously the market has seen gotten a boost here yesterday with the bigger move in the market. Today we're kind of halting just a little bit. We're kind of stalling at highs. We got a couple of stocks that are getting big movers, say, showing a little bit of the consumer side of the story. But Blake, I mean, what's your thought at this point? Nice update yesterday. Gold almost matched the gains in the S&P. Is this the point where the market breaks out higher, or you feel like the probabilities, or we go lower? So if we draw a line at here at this point, 57.70. If we look back, 30 days from now, higher or lower, probability wise.
If we look, yeah. So if going forward, I think we're going to push one more time, but I do think it's going to be a rug pull. It might be right now. I mean, we could see it today. That would not shock me to see this rally, this recovery, kind of have the run out, because I still think people are digesting. And we've seen this before. Fed day, everybody goes bullish on Fed day. It's just, I mean, you really, if you wanted to flip a coin, well, I wouldn't even say flip a coin. Any Fed day, you're going to be right 90% of the time. And that's not an exaggeration. If you just buy on Fed day, doesn't matter what they do. If you just buy, people see it as the Fed is here to save us. They're here to fix it. But Fridays after Fed day, it is equal odds that they're going to sell off. They're going to unwind all that Wednesday, Thursday bullishness. And so, in my experience, and so it could be today, but I do think we're going to try to push one more time higher, because I think the market wants to, it's like we talked about, they want to be not the one holding the bag. It's the greater fool's theory. And we're going to try to push it one more time and pass as much as we can onto the retail trader, which is the highest level they've ever been. And if we can get out at record profits, says the big institutions, then we'll let you guys hold it at the higher levels, and we're going to go to the sidelines. And then when it all comes collapsing down, we're sitting on cash and we're going to pick it up at the lows.
Yeah. I mean, look, the range here, if we kind of look at this ascending triangle, I mean, we got about 600 points off of 5,700. I mean, that might be 6,300 in the S&P. Again, I think that's a long shot, but the reality is, look, that's the possibility here. We may see much higher prices, and tops are created not in selling, but advancing prices. But again, as we look at this, is there a little bit more room to run in terms of volatility? If we look at the VIX as an example, VIX, we're at about a 16 handle. We got some room to the downside, 15, maybe 12. And more importantly, I look at this as a 3-month to 1-month VIX ratio. We kind of look at this ratio. We ticked up to about 1.16 currently. We have a little bit more room for vol to get crushed on that front month, to push this ratio of 3-month to 1-month volatility in yellow above 1.2, which means 3-month volatility is 20% higher than 30-day. So I do believe, I think you're right, there's still a little bit more room to run to the upside. But when you look at skew, again, going back this number, again, this is saying the tail risk has never been greater in the market. So while the probabilities are in the near term, we go higher rather than lower, the downside risks are the most extreme we've ever seen. And and again, that 50 basis point cut basically says the market is not buying this thought process. They may be long, but they're increasingly getting more hedged into the strength. And who's piling in here? I mean, as we talked about it at our live event last week, that households have never been more long stocks with low savings. Companies have low savings. Stock buybacks are going to be an issue. And so as we look at a couple of companies here, I mean, think about corporate earnings. FedEx, and we're looking here pre-market. Let's just look overnight. Did you catch what they said regarding their earnings announcement overnight?
I didn't.
So
I just saw that as a mover.
Yeah, I mean, essentially, they really cut their guidance. I mean, we're struggling. I mean, this is a shipper, right? They're down 40 points overnight from the close. This is a massive move that we're seeing in FedEx. And it just kind of just shows. I mean, we're looking at an expected move about 15. Right now, we're moving 40. I mean, this is way, way outside of what anyone had anticipated for the earnings. And this is a bellwether stock. I mean, it's a transportation stock. It
Well, and
ships
add
stuff.
well, and add to that that how much of their business is delivering for Amazon. Is this a bigger sign if they're giving that kind of guidance? Are they telling you that the consumer is tapped? They don't have anything. They
Yeah.
won't be buying. They can't buy any. If their credit cards are maxed out, highest debt possible, no cash, and biggest credit card default, how much Amazon is going up? Going
Yeah.
to how many sells in Amazon? Now, Amazon, obviously, Amazon Web Services is equal portion to what they actually sell, but it's still going to be, I think, confirmation that we're talking about a overly tapped out consumer. I knew that they had
Yeah,
said
Amazon
negative, but I
Amazon
didn't see what the
mostly
guidance was.
does its own shipping. They don't entirely do it. They
Yeah,
use U.S. Postal Service because it's subsidized too,
yeah, yeah.
but
U.S. Postal
they
Service,
predominantly
FedEx,
use their own.
UPS, and
Um,
their own.
but again, is it Amazon fulfilled? Not everything you sell by an Amazon is Amazon fulfilled. But here's the
Yeah.
deal, though. I mean, so someone asked, TD says to tighten up your stops. Here's the reality, right? FedEx is going to close at 300 and open at 260 ish. The reality is this environment, if we realize the teller side, the stops are not going to save you, right? It's one of those things you have to increase cash levels, right? Because if we start to slide, depending on the stocks you have, overnight gaps, big intraday moves, liquidity dries up, and slippage happens. So the way that you manage this is the way that institutions are managing this, and that's what skew is telling you, is they're ramping up the hedges, right? So TheoTrade, we teach you about how to hedge using things like the atomic hedge, the VIX volatility spread. Don walked through one of those yesterday in his inner circle. But the idea is there's ways to hedge downside risk. So being hedged, having higher cash levels, that's how you operate in a high skew environment because the risks are great. Now, a melt up, what this tells you is with high skew, it does not say the market's going to rip higher. What it says is the market is going to have a higher frequency of small updates. So you're going to grind to the upside, right? Well, the downside risks are very, very significant. So normally when skew gets this level, it's saying that the upside moves are going to get shorter and smaller, but more frequent. And
So on the
so again, we may just go just directionally one direction, but again, the
it's the
moves will get
bearish gamma,
significant.
right?
Sorry, to say it again.
We end up creating bearish gamma.
Yeah.
And so what happens is they sell calls to fund their long puts. They basically collar it or married put kind of strategy, and they protect their positions. They sell calls and they buy puts and they buy out of the money puts. But when those puts go lower, just like when we get a gamma squeeze up, because someone bought calls generally out of the money, and the market makers sold calls, when it gets past there, they have to buy the stock. Well, the opposite is true as well. Not only are they hedging, but the hedge can actually turn into bearish gamma squeeze. And if there's enough puts bought, then that means market makers sold those puts. And to offset that, just like they have to buy stock to offset calls, they have to sell stock to offset puts. And so it
Yeah.
really can super squeeze to the downside.
Yeah. Someone is asking, was this caused because of COVID? Yes, right. I mean, we printed the Fed expanded their balance sheet by $5 trillion in a very short period of time. Yes, it occurred during Trump's administration. And again, these policies have continued ever since. But the idea is this has always been an effect, right? The idea that the Fed comes in, they just have to come in bigger and bigger every time. So yes, we pump 5 trillion. Now we're cutting 50 basis points when we're not supposedly experiencing any economic weakness. Everything's cheery and inflation's high. So again, the policy actions have to get more and more extreme just to try to hold any semblance. But the fact is, the Fed at this stage, because of the indebtedness that's already been created because of those policies over the last 4 years since COVID, the reality is that we're brimming in debt. There's very limited capacity for banks to really expand credit and the money supply. So again, the risks are evident. You're looking at skew, but again, evident as you look at the economy, we have very little ability to push the envelope And so if inevitably there's just going to be increased risk to the market as recessionary pressures build. But anyway,
Well, it's
this
like one of
comes
your
from
favorite sayings, like pushing on a string.
yes, because now we're pushing on a string. You're not going to push along. Comes from excessive government spending. Yes, that too, right? So the Fed prints money, buys government debt from the primary
Mhm.
dealers. Those primary dealers get dollars with which they can lend. The Fed then removes any reserve requirement in 2021. And so now we're in a position, who knows how much money is going to be sloshing around? Who knows how long it's going to take? But right now, again, the perception on the part of institutions is that downside risks have never been greater. Now, as we look at kind of the bulls and bears scenario here, pre-market movers, FedEx, Nike, they're having a big upside move because of the so Don's got a ton to cover before the bell, so we're gonna have to wrap here in a second.
Yeah.
Oh, sorry, about 10 minutes. Let's talk bulls and bears here. So Nike, they're gonna be up nicely today. They do not
So,
have earnings quite yet.
and
We have,
I'm leaving them on my bear list.
yeah,
And
is
so
this yeah,
even though that it's going to gap up, I'm watching for failure at 90, and I'm going to fade into it.
it's not a bad scenario. I mean, when you think about contrarian type strategies, right? This is a big
Mhm.
move. We're almost closing the gap. In out
Right.
spreads, what
Yeah.
type of strategy would you kind of look to do here?
Well, so if it hits the lows, even retest it, because lots of gap up and gap downs there at about 89. So that's why I say about 90, somewhere between 89 and 90, where it established some barriers. When it gets into there, I will look to see, isn't like we're talking about, skew is high despite the market going up. And so at that point, sell calls to fund puts, just like they are doing, but sell call verticals to define risk trade it to buy a put out even longer and
Okay.
maybe even do a diagonal. So it'll be a short call vertical with a bearish put diagonal after we get up there and test that level. So even though it's going to push higher, I think we can get there probably today or tomorrow, today or Monday, I should say.
Not
That
not too
I'll be
dissimilar
looking for an
from
opportunity.
not too dissimilar for the catapult, right? Because I mean,
Mhm.
we're talking about selling premium to buy something. And as we look at Nike here, if we come out to how long? 56 days, 28 days,
So I'd sell 3 to 4 weeks, but
three
then
to
I'd
4 weeks.
do a diagonal or a calendar on this out at least 45 days on that one.
Okay, great. Um, let's say take a look at another one here. So we're talking industrials. We've got Northrop Grumman, we got RTX. Blake, are you a warmonger here with these trades?
I am a war opportunist.
War opportunities. We just acknowledge we're not. How about a war agnostic?
I
We're
am
just
I'm actually
recognizing.
very much anti-war. I think we should be getting out of everything. But I also know, hey, it's still going to happen. Why not take advantage of the
Right.
opportunity?
We got to follow the money, right?
Yeah, follow the money wherever it flows.
So we're
So
down. We're
these are not a
not down
breakout
on
yet.
war, but we
I
have
think
to
they're
acknowledge that where the money's going.
Yeah, and I think these are not signals as far as confirmation, but I think they're very inexpensive and very likely to continue to move higher, especially with what's going on in uh, with Russia, Ukraine, and with Israel and Hezbollah. So
Which I mean, we're talking inflation. I mean, oil. I mean, we're just remaining subdued. The SPR is drained. They don't have the money to really fill it fully. But anyway, but
mm,
Treasury's a little low because the Fed's not giving them any money. But look, I mean, oil is suppressed, but again, the upside risks here are big. And
mm.
again, there's a lot of rumblings out there, which again, we think about gold. I mean, gold itself, GLD had a nice breakout last week. We kind of bounced yesterday. GDX, I mean, especially if the market's going to be bullish, GDX will likely outperform GLD. Do you have a particular target here in GDX, Blake?
I think it's a breakout, and so I would go from that last bounce to that last high, which means I'm going for about a 10 to 12% move. That's
About
depending on if you use
six,
shadows or closes. So
uh, $6 off those might give 45.
yeah,
I mean, my target on GLD was 240. We kind of hit that, and it's like we had the Bank of Japan hold rates the same. Bank of England, what was their decision, Blake? I forgot.
that we're seeing inflation uh, spike up. So I think they're leaving it alone, but they're possibly going to be discussing going opposite. So are we going to
Dollar yen. I mean,
yeah.
so Bank of Japan holds rates the same. Dollar strengthening here, but again, we had a pretty big breakout in the yen. There's a chance the dollar starts to pick up here, but that'll probably occur as we start to peak in the S&P 500. GE, another industrial, big breakout here as well.
Yeah, and GE is a GE does have the aerospace stuff, which would still tie into my non-war mongering. But GE is a conglomerate. They have so much stuff going on, and like I said, industrials are acting like we're in a growth phase, and so I'm still leaning into GE.
Again, it's reflective of government spending. Again, that still is not curtailed. They have not pulled back, never will. But and again, PayPal is one we talked about trying to take profits here. Last Friday, we talked about looking at re-entering off the bounce here. Big breakout yesterday. Again, this company is a bit different than some of the other ones when you think about Ally and the big drop there and other companies.
They don't
PayPal's pretty undervalued. I mean, relatively speaking.
And I don't think they don't do the same kind of lending like you talked about. A lot of times it's almost like Cash App.
Yeah.
Except for the
They're
credit card they do. But yeah, and the credit cards aren't like the other banks when they do credit cards. So
yeah, I think PayPal on the back end uses Ally. I mean, so again, there could be, there's if the works get gummed up, it'll hurt PayPal. But for right now, valuation, other things have certainly benefited the company. Best Buy, are you bearish on TVs, Blake?
Super
are you bearish on
Game
Boys?
I'm Game Boys, bearish Game Boys, bearish Zunes. I mean, I'm not buying the Zune.
The Zune, you gotta love that one.
This is actually a good device. That's the crazy thing. It was actually a really good quality device. Yeah. Anyway, so I like this lower high scenario, and if we can get through that 95, easy free fall back to 90. But I think there's a low cost trade right where it's at for a 10% drop.
Yeah. Again, this are set up for like in-out spreads, like you mentioned. If it falls higher, sell some call spreads, buy some other put spreads. But again, Best Buy rolling over here, and again may head to retest recent lows. Skechers. I mean, you don't like the Hoka shoes, huh? Is that the when you walk
I love
your dog,
Hokas.
are
I love Hokas
on your feet?
I do actually. I love
Hokas. And you're bearish on Skechers?
I mean, I just thought I brought this one up because it's really fascinating to me to see the amount of volume that went into that sell-off.
Yeah.
And so that was the main thing. I'm not saying I'd short today. I'd hope for a little bit of a bounce before I could do that, but it was such a big move.
63-4 area right here.
Yeah, but it was so much volume behind that. The largest volume single day that we've had in the year, and the largest candle, period, but largest red candle, including gaps. So this was massive. And so it tells me that there's no commitment here, even though I do like my Hokas. Great shoes. But
I'm going to give you some empirical evidence. And when you go to Ross stores, there's a lot of Hokas on the shelves at Ross right now. There was a lot of Nike, and it's interesting on the Nike app. On the Nike app, they've almost perpetually had 25% off. And the last time I looked at the Nike app about a week ago or so, there was no 25% off category. I'm like, maybe Nike cleared off their inventory. They're replacing their CEO. That's my understanding. And so, again, but we've already probably priced in that the benefits there because the consumer is strapped and turning. And I'm not sure about Uggs here, but this is looking ugly right now as we're kind of testing resistance rolling.
And this is the reason why I was bearish Nike and Skechers and Deckers. That I just don't think Nike can continue just because they have
Deckers owns Hoka. I thought it was Skechers.
No. I'm saying I'm bearish.
No, somebody meant Tito says that Skechers owns Hoka. I thought it was maybe I got it wrong.
Who owns Hoka? I don't care who owns them. They're good shoes. Point being still is that these are all bearish. Even Nike, I'm going to take a little bite at it where it's at. But Deckers, Deckers Hoka is owned by Deckers. There you go. You were wrong. I don't care. I would just wear them. Yes, Hokers. Anyway, we're out of time. We got to get out of the way for Don here. But my point is, all of those, they're consumer discretionary. Nike used to be almost the perfect substitute for consumer discretionary XLY minus Tesla. Take Tesla out of the picture, and Nike and the remaining was almost perfectly correlated. So I'm saying I'm betting against the consumer. That's all it comes down to. Betting for war and against people. With that comment.
Hey, don't tread on me with your Nikes and your Uggs and your Skechers.
Yes.
With your Game Boy or Zune in hand. You probably have your Zune. You're still using Zune on the dog walk.
That's right. I'll never own Apple. All right. thanks everybody. We're gonna get out of the way for Don. He's got a lot to cover today. Thank you, Brandon. Thanks for driving. Sorry for the voice. And we'll be back at it at the beginning. Well, here in an hour or so for some of us. We'll be
That's
back
right.
at it here shortly.
Have a great Blake. We'll see you. See you everyone.